stronger until it becomes so strong that it breaks the entire system. Then, and only then, does the dollar die. But it dies last, after destroying everything else first. This isn't speculation. We're watching it happen right now. And understanding this mechanism, this invisible force that's reshaping the global monetary system, is the key to understanding what happens next. Not just to currencies, but to your savings, your investments, and the economy you live in. Let me show you how the milkshake works, why it's inevitable, and where we are in the cycle right now. The Dollar Milkshake Theory was developed by Brent Johnson, a macro strategist at Santiago Capital. In 2018, when everyone was predicting dollar collapse, Johnson said the opposite. He argued the dollar would surge, not despite America's problems, but because of how the global financial system is structured. The metaphor is simple, but profound. Imagine the global monetary system as a giant milkshake. All the world's currencies, euros, yen, pounds, yuan, and emerging market currencies, are mixed together in this glass. That's global liquidity. Now imagine the dollar is a straw stuck in that milkshake. When a crisis hits, when fear spreads, when investors panic, capital doesn't flow evenly. It flows into the perceived safe haven. And despite America's debts and deficits, the dollar remains the safest, most liquid asset in a crisis. So the dollar, the straw, sucks liquidity out of every other currency. Other currencies weaken, the dollar strengthens. And as the dollar strengthens, it creates a feedback loop that makes other currencies weaken even more. This continues until the dollar has absorbed so much liquidity that it becomes too strong. So strong that it starts breaking things. American exports become uncompetitive. American companies see earnings fall because foreign revenues are worth less. Commodities priced in dollars become unaffordable. Global trade contracts. Eventually, the system breaks under the strain of an overvalued dollar. That's when the dollar itself collapses. 57 trillion. Compare that to the 36 trillion in U.S. government debt. The world owes more dollars than the U.S. government itself owes. This imbalance creates the milkshake effect. When crisis hits, everyone who owes dollars needs to obtain dollars to repay debts. A Turkish company needs dollars. A European bank needs dollars. An emerging market government needs dollars. They sell their local currency and buy dollars. That selling pressure crushes their currency. That buying pressure strengthens the dollar. And as the dollar strengthens, the debt becomes harder to repay because it's denominated in a currency that's now more expensive. If you borrowed $1 billion when it cost 50 billion pesos, and the peso falls, that billion might now cost 80 billion pesos. Your debt burden increased 60% even though the nominal dollar amount didn't change. This forces even more peso selling and dollar buying. The cycle accelerates. The milkshake effect intensifies. The 57 trillion in offshore dollar debt didn't appear overnight. It was built over decades through what's called the euro-dollar system, dollars that exist outside the United States. This system exploded after the 1970s when the petrodollar was created and oil-exporting countries accumulated massive dollar reserves. Those dollars were deposited in European and Asian banks, which then lent them to developing countries, corporations, and governments. By the 1980s, countries like Mexico, Brazil, and Argentina had borrowed heavily in offshore dollar markets. When the Federal Reserve raised rates in the early 1980s to fight inflation, the dollar strengthened and those countries couldn't repay. It triggered defaults across the developing world. That was an early preview of the milkshake effect. Today, the euro-dollar system is unimaginably large. 57 trillion includes corporate bonds issued in dollars by foreign companies, loans from international banks denominated in dollars, trade finance in dollars, and derivatives settled in dollars. All of this exists outside the direct control of the Federal Reserve, but it all depends on access to dollars. And here's the critical insight. The Fed doesn't manage this offshore dollar supply to meet global demand. The Fed manages monetary policy for the United States economy. By one country is central bank for that country as benefit. The Fed doesn't care if Turkish companies can service their debt. The Fed cares about U.S. inflation and U.S. employment. When those priorities require tighter dollar policy, the rest of the world suffers. This is the Triffin dilemma, named after economist Robert Triffin, who identified it in the 1960s. To be the world's reserve currency, a country must run deficits to supply currency to the world, but running persistent deficits eventually undermines confidence in that currency. You must provide liquidity or maintain value. You can't do both forever. The 57 trillion in offshore obligations represents liquidity provision. The 36 trillion in U.S. debt represents erosion of confidence. The milkshake theory says that before confidence breaks, liquidity demand will spike one more time. A final surge where the dollar sucks up everything, destroys other currencies, and then collapses under its own strength. The milkshake effect has happened repeatedly. Every global financial crisis follows the same pattern. Capital flees other currencies into the dollar surges, other currencies and assets collapse. Central banks intervened to stop dollar strength because it's breaking the system. Start with 1997. Asian economies, Thailand, Indonesia, Malaysia, South Korea, borrowed heavily in dollars because dollar rates were lower. Thai companies borrowed dollars for real estate. Indonesian corporations borrowed for manufacturing. Everything was fine until confidence cracked. Thailand's baht collapsed 50% in months. Panic spread. Companies that borrowed in dollars faced massive losses. If you borrowed $1 billion when it cost 25 trillion rupiah, and the rupiah falls 50%, that billion now costs 50 trillion rupiah. Your debt doubled in local currency terms. Companies couldn't repay. Banks failed. The IMF stepped in with bailouts demanding austerity. Economies contracted. Unemployment spiked. And through it all, the dollar surged. The milkshake effect in action. Jumped to 2008. The crisis started in the US with subprime mortgages, but the dollar didn't collapse. It strengthened. Why? Because banks worldwide had funded themselves in short-term dollar markets. When those markets froze, European banks, Asian banks couldn't access dollars. They were forced to buy dollars to meet obligations. The Fed had to open swap lines with foreign central banks, lending dollars to the ECB and Bank of Japan so they could supply dollars to their banks. And without that intervention, the dollar would have surged even more violently. Then came 2015. The Fed signaled rate hikes. Just the signal triggered a dollar surge. The dollar index rose 25%. Brazilian real fell 40%. Turkish lira fell 30%. South African rand fell 35%. Russia's ruble crashed 50%. These countries had dollar debts. As the dollar strengthened, those debts became crushing. Now look at 2022. The Fed raised rates from 0 to 5.5% in 18 months. The dollar exploded to 20-year highs. The euro fell below parity for the first time since 2002, a 20% collapse. The British pound crashed to 1.03, nearly parity, the weakest ever. The Japanese yen fell to over 150, a 30-year low, and emerging markets were devastated. Sri Lanka defaulted. Pakistan nearly defaulted. They rely on foreign investment in commodity exports. When the Fed tightens and the dollar strengthens, commodity prices fall and their dollar debts become more expensive to service. Countries like Argentina, Turkey, Pakistan, and Sri Lanka are perpetually in crisis. They're trapped in stage 1. Stage 2, developed market currencies weaken. After emerging markets crack, pressure moves to developed economies. The euro, pound, and yen fall. Not as dramatically as emerging currencies, but enough to cause problems. European inflation rises because energy priced in dollars becomes more expensive in euro terms. Japan faces pressure because its massive debts become harder to service if the yen falls too much. We saw this in 2022 when all major currencies fell together. Stage 3, the dollar becomes too strong for America itself. A strong dollar destroys American exporters. Boeing can't compete with Airbus priced in cheaper euros. Apple sees earnings fall when foreign revenues are converted to strong dollars. Exports fall. The trade deficit widens. Growth slows. Even though the dollar is strong, the American economy weakens. This creates political pressure to weaken the dollar, but the structural forces are stronger than political will. Stage 4, the yen carry trade unwinds. As the dollar surges and stress increases, the yen carry trade, borrowing cheap yen to invest in dollar assets, starts to unwind. Investors who made money for years suddenly face losses. A rapid yen appreciation forces traders to sell dollar assets and buy yen to repay loans. 20 trillion in yen-funded positions liquidating amplifies the broader dollar strength crisis. It's not separate from the milkshake. It's one mechanism through which the milkshake operates. Stage 5, system break and coordinated intervention. The dollar is so strong and global markets so stressed that something breaks. Maybe a major economy facing default, maybe a financial institution collapsing, maybe a commodity market freezing. The break forces central banks to coordinate. They open swap lines, intervene in currency markets, and coordinate rate policies. The Plaza Accord in 1985, the coordinated responses in 2008 and 2020, each time intervention stabilizes markets temporarily but doesn't solve the underlying problem. Stage 6, the dollar finally collapses. After being too strong for too long, after breaking global trade, after forcing interventions, the dollar loses credibility as a stable store of value. If the currency swings from extreme strength to extreme weakness, if it requires constant intervention, why hold dollars as reserves? Central banks diversify into euros, yuan, gold. International trade shifts to alternatives. The reserve premium disappears. The 36 trillion in US debt becomes difficult to finance. Interest rates spike. The Fed prints money to buy bonds, accelerating dollar debasement. Inflation returns to America from a dying currency. This is how reserve currencies die. Not from weakness, but from being too strong, breaking the system and then overcorrecting. Let's map where we are in the cascade right now. Stage 1 is well underway. Sri Lanka defaulted in 2022. Pakistan required IMF bailouts. Argentina has inflation exceeding 100%. Turkey's lira lost 90% over a decade. Egypt, Ghana, Zambia, all facing severe debt distress. These aren't random failures. They're the predictable result of dollar debts becoming unpayable as the dollar strengthens. Stage 1 is complete for many and accelerating for others. Stage 2 peaked in 2022 but remains a threat. The euro fell to parity, recovered slightly but remains vulnerable. The ECB faces an impossible choice between fighting inflation and avoiding recession. The pound's flash crash to 1.03 revealed structural vulnerabilities. The yen fell to 152 before BOJ intervention. Even with intervention, the yen remains weak by historical standards. Stage 3 is becoming visible in economic data. The U.S. trade deficit widened despite strong growth because exports were priced in expensive dollars. Corporate earnings for S&P 500 companies with foreign revenues fell. The strong dollar is deflationary for the U.S., which makes debts harder to service. American manufacturers are complaining. The auto industry, agriculture, technology, all hurt by the strong dollar. This creates pressure on the Fed to ease, but structural forces limit what they can do. Stage 4 is in early stages. The yen carry trade hasn't collapsed, but stress is mounting. The gap between Japanese yields near zero and U.S. yields over 5% is one of the widest in history. That makes the carry trade profitable in theory, but currency risk is enormous. If the yen appreciates 10%, it wipes out 2 years of gains. Traders are nervous, reducing leverage. The BOJ ended negative rates in 2024, and even that small move caused volatility. If the BOJ raises rates further or risk aversion spikes, the unwind could be sudden. 20 trillion doesn't liquidate slowly, it liquidates in days. Stage 5 hasn't happened yet, but triggers are in place. It could be a major emerging market defaulting, a European bank failing, a commodity market dislocating, a geopolitical shock. Any could force coordinated intervention. Markets are priced for a soft landing, but the milkshake theory says that's impossible. The imbalances are too large, the offshore dollar debts are too big, the cascade will continue until something breaks. Stage 6 is still years away, but the path is being laid. Every time the Fed tightens and the dollar surges, it damages confidence in dollar-based trade. China promotes yuan settlement. BRICS discusses alternatives. Saudi Arabia considers yuan for oil. These aren't immediate threats, but they're cracks in the foundation. When the next crisis hits, when Stage 5 forces interventions, those interventions will further erode confidence. And once confidence fades, Stage 6 becomes inevitable. The Dollar Milkshake Theory gives us a roadmap. Over the next 2 to 3 years, expect Stage 3 to intensify. The dollar will remain strong as the Fed keeps rates elevated. This will crush more emerging markets. Additional defaults, more currency crises, more political instability, developed currencies will crack. Maybe Europe facing sovereign debt crisis, maybe China facing capital flight, maybe an oil shock where producers refuse dollars. Central banks will be forced to intervene, coordinated rate cuts, swap line activations, possibly a new Plaza Accord. These interventions will stabilize markets temporarily, but at a cost. Every intervention requires printing more money and further distorting markets. Beyond 7 years, Stage 6 becomes probable. The dollar, after being too strong for too long, loses reserve credibility, not from weakness, but from unreliability. Wild swings, constant interventions, and weaponization through sanctions convince central banks to diversify. Reserve allocation goes from 60% dollars to 50, then 40, then 30 over a decade. Each percentage point represents hundreds of billions in selling pressure on treasuries. U.S. interest rates rise. The federal government, facing higher borrowing costs, becomes trapped. The Fed monetizes more debt. Inflation returns from currency debasement. The dollar loses 20 to 40% of value over a decade as reserve status fades into a multipolar system. For individuals, if you hold dollars as savings, the next few years might maintain purchasing power as the dollar stays strong. But beyond 5 to 7 years, expect erosion. If you hold other currencies, the near term is painful as they weaken against the dollar, but they might outperform in the endgame. If you hold assets in emerging markets, the cascade is devastating. But if you survive the crisis, eventual dollar weakness might make those assets attractive again. Commodities are the wild card. Dollar strength suppresses prices near term, but in the endgame, when the dollar loses reserve status, commodities might surge as an alternative store of value. The dollar milkshake theory shows that the global monetary system isn't stable. It's a sequence of crises leading to an inevitable reset. We're not at the end. We're in the middle, where the dollar is strong and other currencies are dying. Dollar strength is the symptom of system stress, not system health. It's liquidity being sucked out because 57 trillion in debts demand dollars that don't exist in sufficient quantity, and that suction will continue until it breaks the straw. The dollar will surge until it can't anymore. Other currencies will fall until they force intervention. and the system will stumble from crisis to crisis until enough countries lose faith in the dollar's stability. This isn't America's fault. It's the inevitable result of a global economy running on one nation's currency. The Triffin dilemma predicted this 60 years ago. Provide liquidity or maintain value. The dollar provided liquidity. Now value is being tested. The test is coming in the form of the milkshake, sucking liquidity into the dollar, crushing everything else until the dollar itself chokes. The yen carry trade unwind, 20 trillion in leverage collapsing, is one mechanism in this larger process. The petrodollar death is another. The 36 trillion US debt is another. All of these crises are parts of the same milkshake being drawn through the same straw until the straw breaks. Understanding this gives you a chance to position for what comes next. The milkshake isn't finished. We're only halfway through, and the second half, when the dollar chokes, will be more dramatic than the first. Subscribe if this video gives you new perspective.